In this video, we are going to talk about all you need to know about the magic of dividend investment. So before starting, please like this video and subscribe to this channel for our future updates. For many years, people have fantasized about spending their days reading by the pool while earning passive income in the form of dividend checks. Now, they can finally experience this fantasy. Dividends can help you realize your financial goals. However, you must first understand what dividends are, how corporations pay them, and the many sorts of dividends that are accessible to you. This beginner's guide to dividend investing will assist you in your initial steps into the world of dividend investment. What are dividends? Companies that make a profit can choose to distribute all or a portion of that profit to their shareholders. They can also use some of the money to build the company by reinvesting it back into it. Acquire additional businesses in order to expand. Through its corporate venturing arm, they make investments in businesses with innovative ideas and products. It can be used to pay down debt. It should be used for share repurchases. When a portion of a company's profit is distributed to shareholders, the distribution is referred to as a dividend. Dividends must be declared, i.e., approved, by the board of directors of a corporation before they can be paid out to shareholders. There are 4 essential dates to keep in mind when it comes to dividends. The declaration date is the day on which the board of directors announces that it intends to pay a dividend to the shareholders. Ex-dividend date. This is the date, which is defined by the stock exchange, on which any new acquisitions of the stock will not be entitled to the dividends that have been granted by the board of directors. They would be up for the next round of dividends. The date on which the record was created is. This date is always the day after the date on which the dividend is declared. It is the day on which the stockholders must be recorded in the company's books in order to be eligible to receive the dividend for the period in which the dividend is being paid. On the company's side, it's essentially the ex-dividend date, whereas the preceding date is concerned with the exchange itself. Payment date. This is the day on which the dividend will be distributed to the company's shareholders. Different types of dividends. Companies can decide to pay dividends in several different forms, from cash to additional stock shares. 1. Cash dividends. Profits distributed to shareholders in the form of regular cash dividends are known as regular cash dividends, i.e., the shareholders. Whenever preferred stock is issued, the corporation is required to pay the dividend on those shares before a single penny can be distributed to common stockholders. Most firms are reticent to increase or lower the dividend on their common stock for a variety of reasons that will be covered further below. 2. Property dividends. The distribution of property to shareholders, rather than cash or shares, is the case in the case of a property dividend. Property dividends are recorded at their current market value on the date of declaration. Their physical manifestations can take the form of train cars, or cocoa beans, or pencils, or gold or silver, or salad dressing, or any other tangible object with monetary value. 3. Special one-time dividends. In addition to regular dividend payments, a firm may choose to pay a special one-time dividend from time to time. The occurrence of these is rare and can occur for a variety of reasons, including a significant legal victory, the sale of a business, or the liquidation of an investment. Dividends can be received in the form of cash, shares, or real property. 4. Stock dividends. Rather than receiving cash, a dividend paid in stock shares is a pro rata distribution of additional shares of a company's stock to shareholders who already possess the common stock. For a variety of reasons, including a lack of cash on hand or a desire to lower the price of the stock on a per-share basis in order to encourage more trading and boost liquidity, a corporation may choose to pay stock dividends, i.e., how quickly an investor can turn their holdings into cash. A practical example of stock dividends. The common stock of company ABC is 1 million shares in total. It has 5 shareholders, each of whom owns 200,000 shares. The stock is now trading at $100 per share, resulting in a market capitalization of $100 million for the corporation. The board of directors resolves to declare a 20% equity dividend. It prints an extra 200,000 shares of common stock, 20% of 1 million, and distributes them to shareholders in accordance with their present ownership percentages, as described above. Every investor owns 200,000 shares, or 1/5 of the corporation, and as a result, they each receive 40,000 of the newly issued stock, 1/5 of the 200,000 new shares issued. As of this writing, the corporation has 1.2 million shares of common stock outstanding, with each shareholder owning 240,000 shares of common stock. In contrast, the dilution in the value of each share results in the stock price decreasing to $83.33 as a result of the 20% dilution. The most crucial thing to note is that the company, as well as our investors, are still in the exact same situation. As a result, they now hold 240,000 shares at $83.33, rather than the original 200,000 shares at $100. Its market capitalization is still at $100 million, according to the business. Evaluating dividends. Whether high dividends are good or bad for you depends upon your personality and financial circumstances, and the business itself. A company should only pay dividends if it is unable to reinvest its cash at a higher rate than the shareholders are able to if they receive a dividend. So, if company ABC is earning 30% on equity with no debt, the board should elect to retain all of the earnings, because the average investor probably won't find another company or investment that is yielding that kind of return. At the same time, an investor may require cash income for living expenses. In that case, they are not interested in the long-term appreciation of shares, they want a check they can use to pay their bills. Additional ways that companies and stockholders can evaluate dividends involve the payout ratio and dividend yield. Dividend payout ratio. The dividend payout ratio refers to the percentage of net income that is distributed to shareholders in the form of a dividend. It is significant in forecasting the growth of the firm since its inverse, known as the retention ratio, the amount of money retained by the company and not distributed to shareholders in the form of dividends, can aid in estimating the growth of a company. Coca-Cola's flow statement for the year 2003 shows that the business distributed $2.166 billion in dividends to its stockholders. A look at the company's income statement for that same year revealed that it had earned a net income of $4.347 billion. The following steps would be taken by the investor in order to compute the dividend payout ratio. The response, 49.8%, informs the investor that Coca-Cola distributed over 50% of its profit to shareholders during the course of the year under consideration. Dividend yield. The dividend yield tells the investor how much they are earning on common stock from the dividend alone, based on the current market price. It is calculated by dividing the actual or indicated annual dividend by the current price per share. The dividend tax debate. Most dividends are taxed at a lower rate than normal income. So-called qualified dividends are taxed at the same rate as capital gains. For dividends to qualify for the lower rate, stocks generally must be held for at least 60 days. Selecting high dividend stocks. An investor who wishes to build a portfolio that earns a substantial amount of dividend income should pay close attention to a company's dividend payment history. Only companies having a consistent track record of steadily increasing dividends over the previous 20 years or longer should be evaluated for inclusion. Furthermore, the investor must be convinced that the company will be able to create the cash flow sufficient to make the dividend payments in the foreseeable future. Dividends depend on cash flow. Dividends are determined by cash flow, not reported profitability, and are paid out quarterly. If cash flow was strong, almost every board of directors would still declare and pay a dividend, even if the company made a net loss on its income statement. The explanation for this is straightforward: investors who favor high dividend equities seek stability. When a corporation reduces its dividend, the stock price is likely to fall as investors become nervous and sell their shares and move their money elsewhere. Because of this, firms will not increase the dividend rate just because of a single profitable year. Instead, they will hold off until the company is capable of earning enough cash to keep the dividend payments at their current levels. In the same way, they will not reduce the payout simply because they believe the company is experiencing temporary difficulties. What do you think of our video? Let me know in the comments section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.